Good afternoon, everyone. Welcome to our monthly webinar. Today, our topic is Advanced Wealth Transfer Strategies. During today's webinar, our advanced tax and estate planning attorney, Michael Lee, will discuss some of the most common advanced wealth transfer structures our clients have utilized, including CRT, CLT, GRATs, IDGT, and private foundations. So if you are not familiar with any of this terminology, don't worry about it because Michael will explain to you in details. First, I'd like to introduce myself. My name is Xiaowei Li. I'm a partner with RUI Attorneys. Together with me is attorney Michael Lee. Michael, do you want to introduce yourself?
Oh, well, it's great to be here for our monthly webinar, and I'm also glad to be here for the one that's in English, because that one's a little easier for me. So very happy to join. And because there have been some changes with the Big Beautiful Bill Act, all of that, there are some interesting things to glean from this. Also, I have to update my bio with a little personal news. Of course, the old bio had chair of the Board of Legal Specialization, of which I was greatly honored to be chair of the CBLS board. But as of, I believe it was last Thursday, the California Supreme Court has appointed me to the Committee of Bar Examiners. So I was served with the order, I believe it was last Thursday. So will now be on the California State Bar Board to administer and design the bar exam for future California lawyers, and we wish them all luck going forward. So a little bit of news on my side.
Congratulations, Michael.
Thanks.
Without further ado, let's just start today's topic. I know we have a lot of content we want to share with our audience. Sorry, before the start, our webinar is for educational purpose only. So if you have any questions, feel free to reach out to us. You can either email us or text us at 650-678-6666 or give us a call. But if you have any individual private questions, feel free to email us, contact us. Today, our webinar is for general information only.
Educational and entertainment purposes only. This is really what our objective is for this, is so that you can be good legal consumers to know what may be useful for you or not useful for you, and what questions to ask. Please don't begin transferring assets because you said I saw a webinar. There's more to it, obviously, but we want to make sure that you're informed and empowered to know what things are and say, maybe that may be right for me, just like those pharmaceutical ads, maybe this medicine is right for me. They say, don't go start taking it, go talk to your doctor first. That's our goal.
Sounds good. Michael, go ahead.
Yes, so jumping right in here, what we're talking about is the first lay of the land, what is going on. So we had some good news, depending on which way you think about it, is the One Big Beautiful Bill Act, the OBBBA Act passed, and that solved the problem that we had prior to its passage of, likely you've seen our prior webinars before, talking about the sunset of the Tax Cuts and Jobs Act, the old act, under Trump. We now have a new act, and the change here is that the individual estate tax exemption for U.S. domiciliaries, citizens, permanent residents that are here, people who have domicile here, is now set to $15 million per person, starting in 2026. And there is no longer a sunset. So we don't have a time out on the horizon that this exemption, this 15 million, will suddenly be cut in half, like we had under the old Tax Cuts and Jobs Act. And so I've seen a number of things, and even I've used the word myself, where I've said, oh, the exemption is now permanent. And this reminds me, again, to go all lawyer on this, and with the answer, it depends, but I feel kind of like Bill Clinton in that deposition. And well, it depends what your definition of the word is. Permanent, this idea of definition of what is the definition of permanent? Well, permanent is forever, right? Well, the the OBBBA Act, yes, the law now stands under the estate tax code that the exemption 2026 going on to the future is $15 million per person, and there's no sunset. That is permanent, but it's permanent in the sense of laws of Congress are permanent. The laws of Congress change as politics change over time. If politics changes and the composition of the House and Senate change over time, this may, and perhaps very likely, may be revisited. Just we have no firm date like we did before, but there may be changes. So that idea of doing planning now is still a very good idea because depends on the definition of the word permanent, and permanent means permanent as of the law now, providing no one changes it, which could happen. We still have the top transfer tax rate at 40%. So this basically means that for north of $16 million per person, you would have an estate tax rate of 40%, same as gifts over that amount, 40%. So that all stays the same. And portability is still preserved. So portability, I could just say, give all my assets to my wife. She'll take all of the assets from me, and I can also give her my exemption. So she can take my exemption and she can take all of the assets, live her life, and then when it's her time, she'll have two exemptions, mine and hers, and then she will have, of course, the assets. So it makes some estate tax planning easier. Same as step up in basis, that's the same. That hasn't been touched by this act. There's always some gossip about whether step up in basis may be reconfigured or changed, but thus far, we're all good. So this is just a short little list of planning opportunities to consider. We're going to go in depth into some options in a moment, but these are just some light general opportunities to consider. So one of the first things to consider is recalibrate lifetime gifting. There is, because the exemption now is quite lavish and we don't have a sunset and we don't have issues of clawback or anything like that, it may be time that if someone said, I just want to gift that particular asset, it's $1 million, I just want to gift it. I was hesitant before because maybe that gift, if I did it, it might bite me if there's sunset, and then if there's clawback, maybe it's going to bite me, I have a problem. Well, there's new room for that. This can be back in play. This is particularly in play for things like ILITs, if you have significant whole life insurance policies that are not in ILITs, and you said, it has a surrender value, or the fair market value on the 712 is $500,000. I'm a little bit not sure if I want to use my gift on that or not. Well, now at the $15 million gifting, maybe it makes sense, because if I don't gift it and the death benefit is in my estate, maybe I have a problem. Maybe that's too much. There could be an opportunity there. So gifting, that's something to think about. It's easier to gift because running afoul of the gift tax is less likely because exemption is high. Next point down, estate, we call them freezing techniques, fixing value for particular assets via sophisticated transactions like GRATs, Grantor Retained Annuity Trusts, or the analog, the similar option, a sale to an intentionally defective grantor trust, or family limited partnerships, LLCs. Those still are good strategies for large and fast growing estates. And now, because the estate tax exemption is permanent and high, and there's no sunset, we can be a lot more free and potentially seek out opportunities to do this gifting, because we are confident, because the law doesn't have this, that it's not going to bite us again after the sunset. So if one is blessed and lucky to be having those assets that we often have in Silicon Valley, of assets that appreciate rapidly and make sort of magic millionaires and billionaires, if that's there, we may want to use these strategies to gift this at the particular value now, settle the value, which is freeze the value for our estate, and get it into a vehicle like a GRAT or an IDGT, on and on and on. So that is in play. The other thing that is in play is for married couples is ensure you use portability in case something happens to husband or wife. Basically, the IRS has given you credit, money on the table. If, God forbid, something happens to your spouse, file the Form 706 timely and take the exemption. Even if you say, oh, we're a moderately, high net worth family, Mike, we're not even that much, we're just 10 million. One of our exemptions will cover it. It's fine. Okay, one of the exemptions cover it if it's $15 million a person. But if we go back to just the beginning of the year, and it would be it's sunset, and it was going to be 7 million, 7 million, well, then if you don't claim your spouse, you'll only have 7 million. You'll be short. And, again, remember this idea of permanent. Permanent for lawyers doesn't really mean what permanent means for everybody else. It just means permanent until Congress gets around to changing it. So don't leave money on the table. If you or family or friends have something unfortunate like this, of course, it's awkward to think about taxes, but it is the prudent and smart thing to do, is to say, you know what, my spouse left me the assets. My spouse also left me the credit. In case that's needed in the future, file the 706. In fact, if you're just doing portability, filing the 706 is not terribly complicated. So get it filed. That's good. So continuing on, basis plays with bigger exemptions, you can allow more assets to be included in the estate to capture step up in basis. You can also swap low basis assets from grantor trusts. So essentially with this is just dialing in the design of the estate with what's in your general revocable living trust plan and things that may be in irrevocable trusts or with other family members. Is there an opportunity for strategic gifting? So that's good. The other thing that we would want to take a look at, and I recommend everybody taking a look at, is document tune-ups, document cleanups. I still encounter, it's been since 2010, so it's been almost 15 years since we got portability. I still see revocable living trusts for couples. And the couple says, we totally agree, we don't have a concern. We want administrative ease. I don't want a really onerous Q-tip in case I go where the half of the estate locks and then my wife has to administer the marital share and then go over to her, or some of the really bad 2010 ones. It's not even a marital share. It's the bypass trust or the family trust gets funded, and it's funding in the old pre-2010 way. It's been 15 years. I still see these almost every 2 weeks where clients look at it and say, I have no idea. I didn't know I ended up with this. Do the tune-up and take a look. Make sure that your marital formula for how you're allocating, if I pass, how we use the marital exclusion and we're using each person's exemption, get that tuned up and make sure it's operating in the way that you want. I, again, frequently see those still loom around that are not what clients were looking for. And when they hear like how, what happens, if someone passes, how the trust is going to be operated. I still get, again, a lot of clients saying, whoa, that's not what I want at all. Well, we better get ahead of that, fix that. The same way to take a look at is also just general trust funding. I still see constantly trusts that the real estate is not funded. The real estate's not in the trust. And that is a significant problem, because really real estate is one of the first things you want to capture. So document tune-ups, funding, make sure that's checked into. And then the other thing to take a look at is state death tax issues, if that's in play. Because we have our webinar is broadcast. We're licensed in, of course, California. I think a lot of you are Californians, but we're licensed in Washington State. We have some Washingtonians on, and I think we're also licensed in Nevada. We have some Nevada people on. This varies for you. California and Nevada people, you don't have the state death tax. but Washingtonians, and I see some of you on, you guys know you've got it. And so you have to think about things for your Washington state death tax. How do you want to deal with that in terms of where you are domiciled, how the trust works for if you have a Q-tip, all of these different things. Because the state tax systems, like Washington state, that didn't change. The federal system is the only one that changed. The Washington system is still the Washington system, which can impose a tax there. The same way for persons thinking about California, Nevada domicile, that still is available, but one has to think it through very carefully. So that's just a little bit of the lay of the land before we jump into the specific options, and we'll take a look at what these are and where they may fit for you and fit with the OBBBA. So let's keep on going. So Charitable Remainder Trusts. I mentioned this one first because this is the one that I'm seeing constantly that clients are using. I see clients constantly using this, and we are constantly drafting these, partly because these are working quite well for clients, and they tend to fit Silicon Valley clients very well when they have this particular problem. And all of our slides are going to go in this standardized format. We'll give you the potential option, and we have a what is it, what's it for, pro and con. So CRTs, what are these? The technical term is these are called split interest trusts. They're split interest charitable trusts. And essentially the way that these operate is we create this box, this CRT, and method is I transfer assets that have high built-in capital gains into the CRT. The CRT sells the asset. CRTs by the tax code, by the IRS code, the CRTs at that moment that they liquidate the assets, they are not subject to capital gains tax at that time. What the CRT does is it pays either a fixed interest annuity or a Unitrust, a percentage amount revalued annually, back to me over a term of years. And the taxation flows back to me as I receive the assets. So if I throw the asset in there and it's a 20-year term, the CRT can sell the assets immediately, capital gains tax-free. It can reconfigure the portfolio to diversify the portfolio. It will then pay me back essentially like an annuity, year over year over year for 20 years of the fraction of the trust. And that it will be, of course, calculated that I'll get this over 20 years. And I'm essentially paying the tax, the capital gains tax and the other taxes that are generated in 1/20th increments. So I've spread, it's a tax deferral system, spreads the taxation over, instead of all in year one, over 20 years. It also enables me to diversify. So if I'm stuck with a particular asset, like a particular stock symbol, and I say, I'm all eggs in one basket on this one, I'm locked in here, I would like to get out of this because I'm at my particular age or my particular wealth level, I would like to diversify and not be all in. This enables one to do that. And it will also generally give an 8 to 12% charitable tax deduction in year one. So if I want to liquidate some stock just directly, because I'm going to buy a house or I'm going to pay for kids' college or I'm going to do something like that, I can do that. That's going to be in my general 1040. But then I can get a little bit of a tax deduction by doing the CRT, by granting the other part into the CRT. We can kind of see what this is for. It's basically to convert something that's an appreciated illiquid asset into a liquid stream of income, and deferring the income tax gain recognition on that asset. In Silicon Valley, where I see it used constantly, is people tend to be tied up in one particular stock symbol, usually from their companies. They say, I have tons of, fill in the magic company of this year, I have tons of this stock. And on paper, I'm massively wealthy. But I am very, very vulnerable. I've talked to my financial advisors. I'm very vulnerable because the symbol is vulnerable. So I would prefer to liquidate all of this and get into like S&P 500 index funds, international index funds, and have perhaps lower growth but lower risk. I want this diversification. This can be a great tool to do that. So that is what it is and what it's for. Let's see the pros and cons. There are pros and cons. The pros, you get this immediate income tax deduction subject to AGI limits. Usually it goes down to 30% of AGI. Sometimes it could be 60% of AGI, but it can be carried forward. You have tax-exempt trust growth. Sales inside the CRT avoid immediate capital gains tax. It's when it flows out to you. You have some estate tax reduction because with the estate tax reduction, you've gifted some of this asset out. And you have some flexible payout designs that could be up to 20 years or the lives of the persons. There are calculations that are run. So it can be tailored. There are some cons to this. It is an irrevocable trust. I can't do this in year one and say, great, I'm going to throw the asset in there. I'm going to sell it. I'm going to diversify. And then after 5 years, I say, the market's not so good. And, I really want to buy, a big house. I just turn this off. Give me all my money back. No, you have to keep doing this income flow back system. You can't just say, turn it off, give me my money back. And I'm going to take it all out of the CRT. It doesn't work. The payout actuarial constraints, you have to calculate this out. That can limit, and change the look of the CRT. So generally when we work with clients on this, we're working through the calculations, seeing is there an asset and a value there that is suitable for the CRT, that produces income tax results and ultimate residual amounts that we can live with. There's some setup fee and ongoing administration costs because one has to keep this tax compliant. It files its own tax returns. The annual filings are generally the tax returns, but it doesn't file anything like an LLC to the state. So we don't have that. The other thing is the distributions are taxable to the recipient, and it's generally ordinary income first, then short-term capital gains, long-term capital gains, and return of principal. So it's usually worst out, first out. Ordinary income comes first, but you generally just design the portfolio to not have high income producing things, just do capital gains. The other thing is that with these, they are remainder trusts. It has to be designed that what you put in ultimately over the term of years, 20 years or lives, at least 10% ends up in the hands of the charity. The charity will just make a note towards the end of our lecture here, can be a private family foundation. So think about that. It doesn't necessarily just have to go to the Red Cross. You could have it actually exit your charitable remainder trust and then go into your private family foundation. You can't use the money for private inurement, your personal use, but you can use it for charitable endeavors, and you could do that continuing over time. A lot of people do that. So that's the CRT. The other thing is generally for, depending on how you do the design, you need to outlive the term. If during the, I have a 20-year CRT and I'm a single person and I pass away, then that will cause the bottom of the box to open up and the balance that's left in the CRT to drop to the charity. For term of years CRTs, depending on the situation, we can usually solve that. So there are things that we can do. Let's move on a little bit because CRT, that's the one I see a lot. I want to spend a little bit more time. Some of these I'll go a little bit faster. Charitable Lead Trusts, I'll go a little bit faster on this one. So Charitable Lead Trusts are another tool that people use. The first one we saw, Charitable Remainder Trust. What are we dealing with? Capital gains. CRT, when we see CRT, we think capital gains. I got a problem here. I want to liquidate, but I kind of don't want to because of the income tax. The Charitable Lead Trust is the reverse. The Charitable Lead Trust is the reverse. And this is the same concept of this split interest trust, but it's mirrored in that in the Charitable Lead Trust, the charity gets the payments for the set term, and the remainder goes to non-charitable beneficiaries. So it's flipped. So CRT, I put the $1 million or the $1 million of stock in, the $1 million of stock is sold, and it pays me the annuity with the remainder going to charity. The charitable lead is the exact mirror opposite. The payments go to the charity, and then the remainder goes to the non-charitable beneficiaries. And this also has an option where it can be a grantor trust, where the donor is taxed on the income, and there's an upfront income tax deduction, or it can be non-grantor, the trust pays its own taxes, but there's no donor income tax deduction. So sometimes these are done via cash, because there's no built-in capital gains there when someone puts in the $1 million cash, and then they get an income tax deduction for putting in the initial principal amount, and then we have the flow of the payments to the charity over time, and then there's the balance. So what's this for? This is generally providing immediate charitable funding and then shifting wealth to the heirs at a discounted gift tax value. Basically, it's sort of like this estate tax freezing strategy. It moves the future appreciation of the asset out of my estate, and it causes the charitable funding and the charitable payments now. So if I want to begin funding my charity, and I want the large income tax deduction now, and then I want the future appreciation of this asset to go to the kids, so the $1 million, that will end up, the lead payments on that will go to the charity, but then the balance drops to, let's say, my kids. That's what this is for. So let's go on to the pros and cons here. So pros, this is an estate gift tax strategy. It also can be a strategy for generating an income tax deduction. So if I want an income tax deduction, but basically I want to say, well, I want to give a gift to the charity of $1 million over 10 years, but I want it to be actually, I want to give them basically just the $1 million of the value, but the appreciation on that, the growth or income on that $1 million, I don't want to give them. I want that to actually end up with my family. That's what the Charitable Lead Trust can do. This is, of course, there's some cons. It's the irrevocable trust like the CRT. I can't just turn it off. And there are some investment risks if, let's say, the portfolio doesn't perform that well. Maybe there's no remainder. That can be a problem. We also have to be careful if we're taking the charitable deduction and it's a grantor trust, that there can be this phantom income. The same way I got the deduction in year one, I may also get kind of stuck in that I also got capital gains in year one. That's why these tend to be funded with cash. So these can work very well, but these especially require tailoring and dialing them in. So let's move on a little bit from CRTs. Grants, Grantor Retained Annuity Trusts. What are these trusts for? These trusts are basically, these are non-charitable, not for charitable purposes. These are just for estate tax purposes. And what this is for is essentially this is for, if I have a particular asset, I have the Magic Company stock, and right now the valuation is $1 million, or it's $5 million, etc. And I say, this is the Magic Company, this is the Magic stock, and there can be there's likely to be significant appreciation on this, and I would like to basically freeze this at the $5 million level. Husband and wife, we're fine with $5 million. Any overage of growth of the beyond $5 million, I want that to just go to the next generation. And the way that this works is that we create the Grantor Retained Annuity Trust, create the box, I throw the $5 million worth of stock in, and the trust agrees to pay me basically $5 million plus interest at this 75/20 rate. So it agrees to say, okay, it'll pay me $5 million plus that interest over the term of the GRAT, however long the term the GRAT is. And essentially what this does is, let's say I say a 5-year GRAT, it will pay me $1 million back year over year for 5 years, plus the interest. And the key thing is, when it pays me the $1 million back, this GRAT does not need to liquidate that stock. So what I can do is, if I have the stock and it's traded on the public markets in my brokerage account, I have it in my personal account, I create the GRAT account is created, I transfer the $5 million in stock in the GRAT, and then I follow the rules of the GRAT year over year of where I pay the annuity, and at the, let's say, end or beginning of the year, depending on how the GRAT is designed, I basically calculate, well, what's the price as of today? How many shares does that equal? That's $1 million plus the interest, and I just transfer the shares back to me. The hope is that the value of the shares are increasing over the term of the GRAT, so the shares that are coming back to me are fewer and fewer and fewer. And the hope is again to freeze the value at, let's say I just have the 5 million, but the growth is all going to the next generation for estate tax purposes. This is a Silicon Valley favorite for estate tax, gift tax purposes. There are, let's go to the pros and cons. There are some pluses and minuses with this. So let's go to the next slide, the pros and cons here. Yeah, there are some pros and cons to this. One of the things initially is, with the high estate tax exemptions, a lot of clients say, well, do I really need this? It's 30 million, I think we'll be okay. Maybe, maybe not. One really just has to think about, well, what kind of asset is this? What's the potential for growth? What is, versus the cons of the GRAT? Is it, better to do or not to do if the startup, et cetera, or the particular stock portfolio really, really performs well? Do you have an estate tax exemption? If you say, no, we're so far away from the 30 million, we're not going to have that, even if they cut it in half, and we're 7 and 7 and it's 15 million, we're not going to have a problem, then maybe the GRAT, maybe not so needed. If we say, 15 between the two, we're kind of close, and it's, we're in the startup industry and we're relatively young, this starts to look good again, even with the high exemptions, because again, we're planning for contingencies and changes. The cons on this really are this, is really the major con is that the initial setup, what costs a little bit to set up, it costs a little bit of time to administer, but essentially with this is the stock comes back to me over time. I don't really have a problem, let's say if the market performs very, very poorly, and essentially the whole portfolio comes back to me, well, I didn't really lose anything. I didn't have the asset locked up in the trust. It all came back to me. It was $5 million when I started, but over the term, it depleted down to 3, when I used it. The GRAT didn't really achieve any estate tax savings because the asset declined in value, but at the same time, it didn't hurt me because I didn't use any of my estate tax exemptions to fund this thing. Because again, it's zeroed out, is that I put in the 5, but then it promised me back 5 with interest. It was just freezing. It wasn't granting gifting. So the Grantor Retained Annuity Trust, little downside if there's performance risk. The same way there is mortality risk. I have to outlive the term. If I have a 5-year GRAT, I have to live past the 5 years. But the worst thing that could happen if something happened to me in the 4th year is that the GRAT doesn't work. I pass in the 4th year and the assets come back into my estate. Basically, I didn't complete the cycle. There is some what's the risk? Well, I lost a little bit of opportunity there, and some administrative fees of doing it and setting it up. But I didn't necessarily have a catastrophic situation. I basically just got what I would have got if I didn't do it. The mortality risk really actual planning can be resolved because generally we do very short-term grants, generally 2-year or 3-year rolling grants where you just keep repeating it. Throw the stock in, if it's 5 million, 2.5 million, 2.5 million, 2 years pass, and then we do it again. 2.5 million, 2.5 million, and we just keep rolling it, and we just basically keep shaving off the top, shaving off the top, shaving off the top. So this can be great for those assets. Grantor Retained Annuity Trusts. The only thing that's bad about these that can be, or I shouldn't say the only thing, but one of the other things that can be a little bit problematic, but is also a benefit in a way, is these generally are not useful for generation skipping transfer tax. And the reason they are not useful for generation skipping transfer tax, or not useful for things like the dynasty trust, is because these can't be a dynasty trust. The Internal Revenue Code says the GRAT can't be a dynasty trust. The GRAT must have the provision that it pays into generation 2. So if I'm generation 1, it must go to generation 2. The only way it can go to generation 3 is if the people in generation 2 have died. So it is basically, from generation 1 to generation 2 to generation 3, like that. So you can't do a dynasty trust style with the GRAT. That being said, California also has some limitations on the use of a dynasty trust. So some clients say, well, the way to really do dynasty trust planning is out of Nevada or Wyoming, both where we're licensed for that reason. And I don't really want to go do that because it requires the Nevada or the Wyoming trustee, and it seems a little complicated. I don't really want to do that. Then okay, great. The GRAT's going to work just fine, because the thing that you don't like, the areas where they have dynasty trusts, we can't do that in California. IRC doesn't let you do it either. So fine, we're just California compliant, IRC compliant. Let's do the GRAT. We'll see the next one. We have a lot more flexibility. So let's take a look at the next one. This is the big one. Interestingly enough, this is as popular as the Charitable Remainder Trusts. Very, very popular Charitable Remainder Trust. The next one that's very, very popular is this Intentionally Defective Grantor Trust. What is this trust? This trust is basically designed, the IDGT, as the gift repository box, basically the future generation gift box. And this is an irrevocable trust that is designed so that the gifts that I put into it, shaving off stock or whatever it is, are completed gifts for transfer tax, estate gift. So when I give the $1 million of stock to this trust, it's not in my estate. I've given up substantial control, usually because I have a neutral trustee in there. That's usually critical. And I've given that up, I put that over. But I retain a particular power that makes this what's called a grantor trust, which enables me to pay income tax on the tax attributes in that trust. So basically, I can put the $1 million in there, and then let's say the $1 million of stock. Let's say if there are sales and things, those capital gain attributes flow back to me, and I have to pay the tax. Initially, every time I explain this to clients, they say, whoa, Mike, that sounds really bad. Wait, I put the $1 million in there, and then I have to pay the tax for the trust? Saying, that's good if you're a high net worth individual. I say, well, why? I said, because the Internal Revenue Code and the Internal Revenue Code regulations do not deem the payment of those taxes gifts to the trust. So of course, the gift of the $1 million, that's a gift, and we have to account for the income, the estate gift tax that you depleted your exemption of $1 million. But year over year over year, you're paying the taxes for that trust and that growth. That's growing tax-free for the trust. You're paying the taxes, but those payment of taxes do not count as continuing gifts. So you can grow that plant and basically use water that's free for the trust. You're paying, and we're basically saying, okay, that trust that's estate gift tax free, that's growing, and mine that is subject to the estate gift tax, that's depleting. So that is the basic idea of the Intentionally Defective Grantor Trust in the estate gift tax zone. With high exemptions, this potentially is less necessary except for very, very high net worth couples or individuals for estate tax purposes. But that's not the only reason people may use these. People frequently use the IDGT in the form of the ILIT, the Irrevocable Life Insurance Trust, is essentially similar, highly similar in terms of drafting and design to the intentionally defective grantor trust. People for that are generally using that to get the death benefit out of their estate. But in addition, for life insurance or also other assets, we often do these because we want greater control over the asset in the future. If the life insurance is going to leave a $5 million death benefit, you say, well, Mike, it's only a $5 million death benefit. I don't have a massive estate. I'm not anywhere near $30 million. But actually, I'm concerned because $5 million, I mean, we are in Silicon Valley, but that's still a lot of money. And I don't want my son or daughter or niece or nephew or whomever to just get $5 million in cash. That's too much, too fast. It's not prudent. I want a design to manage this further that is safer. So perfect. Things like life insurance policies go well in here and can be done through the ILIT, Intentionally Defective Grantor Trust. This also can be done for simple gifting. I say, I just want to begin doing gifting. In fact, Mike, I just want to do the gifting of my annual exclusion. I'm not going to give I don't have $5 million just laying around. I'm just going to gift $5 million. I just want to do some gifting of my $19,000 a year. And actually, I'm married. So it's actually, $38,000 a year per person. I just want to do these $38,000 gifts year over year over year, but I don't want to give it to my grandson or my granddaughter because she's 6, and I just want to earmark this and accumulate it for her, and I want to do investing for it, and then she can have it later. And the reason I want to do this is because I looked at the 529 and I don't really like it. It's too limiting, and the parents already did a 529 for my grandson or granddaughter. I just want to put this in a box for my granddaughter that is controlled, doesn't all go to her at 18, it goes at age levels. I can control it during my lifetime. Then, my son or daughter can control it during their lifetime. I just want a box for gifting, but that's highly flexible. Perfect. IDGT works again. This can work well for this too, and perhaps is more flexible than a 529 or things that are highly broker designed. So these work perfectly for that. They also work well for dynasty trust planning. These are generally where you build in the dynasty trust, where I say, the beneficiaries are the blood heirs of Mike Lee forever, and that's the beneficiary designation, and that captures my children and grandchildren and great-grandchildren, on and on. There is a little bit of a challenge when you do these or consider this in California. The law is generally better and more favorable in Nevada and Wyoming. California, we have a rule against perpetuities, and it's a little bit difficult to deal with, and in some ways can't be done. So the IDGT works well for this. Let's go to the pros and cons. I'll mention just a few things. This works very well for, again, estate gift tax planning. It works well for this tax burn of, again, I'm paying the taxes for the irrevocable trust. If I can sell assets to it, if I want to basically do that thing like the GRAT, where I say, well, I don't want to just do a gift of $5 million. I just want to give basically the appreciation off of the $5 million. I basically want what you were talking about in the GRAT, but I want it done with dynasty trust effect. Well, we can do that. We can sell to the IDGT, and there's no gain on sales to a grantor trust because you're the same taxpayer. So those are the pros. The other thing that I didn't mention, which is also critical for IDGTs and can be, again, a reason why a lot of clients use them, again, for life insurance, but for other things, is they also are very good asset protection vehicles. Because again, I parted ownership and there's generally a neutral trustee. So if I am in a risky industry and I want to basically say, I've got too much in basically too much exposed, and I want to begin gifting assets towards the next generation, but I still want some level of control and some level of oversight. The IDGT style trust could be very good to begin gifting these assets while there's no heat, I'm not sued by anybody, I don't have any problem, but that I'm basically moving these into the next generation. I have a client that owns like an auto repair shop. They do this. A lot of clients that are in the small practice medical profession do IDGTs to basically do significant strategic gifting so that they have asset protection. The tax problem is not the critical concern that they have. They say, I'm far more likely to get sued than have more than $30 million, because I'm an oral surgeon out of a small practice. That's more likely that's going to happen to me. I'd love the $30 million to be more likely, but that's not so likely. They do it for that reason. The other thing that we have, and I don't have a slide for this, but just because it is a variant of this style of trust, is that this is the IDGT, the intentionally defective grantor trust. There are trusts, which we practice, that are irrevocable non-grantor trusts. And going all the way back to our first slide, these are sometimes very, very useful for tax savings, in that these trusts, unlike the IDGT, these trusts are not grantor, they're a closed box, they deal with taxes on their own. They're their own tax person and they're separate. Question, well, why would you want that, Mike? What's that for? Well, maybe I've been to Nevada or Wyoming and said, well, this is a nice place, like to visit, wouldn't want to live here. I like their tax regime, no state taxes, I like that, that's good, like to visit, don't want to stay. Well, okay, what about your assets? Or certain assets, a certain tranche of assets. Perhaps those assets we want to stay in Nevada or Wyoming. And so that would be me gifting, let's say, fraction of a stock portfolio, $1 million of stock, to an irrevocable non-grantor trust. And that trust will, of course, owe federal taxes on the capital gains, all of those things. But if it's outside of California, with a Nevada trustee domiciled in Nevada or domiciled in Wyoming, and it's over there, it does no, and I am not a beneficiary, let's say my kids are the beneficiaries, it will no longer owe California taxes. But then critical, my kids generally also have to not be in California. So it's a harder combination to use, but can be a great combination. If I said, well, my daughter, she's going to University of Washington, so she's over there. And then my son, he's doing a graduate thing. He's at the University of Texas for a while. And then, we'll see where they go. But they're not in tech. They're like in finance. So they'll probably end up, somewhere else thereafter. But right now they're in, Texas and Washington State, and they'll probably be there for, 3-5 years. Now we have the combination, because the asset can move to the irrevocable non-grantor trust, separated from you, neutrally in Nevada, and the beneficiaries who would be drawing from the trust are also in no income tax jurisdictions. So there won't be any conflict there. If they take distributions or draws from the trust, it won't recycle the assets or the income critically back into California. So those can be a play. That's a further variation on intentionally defective grantor trust. That's intentionally valid non-grantor trust, or undefective. I should say the word valid. They're both valid, but intentionally solid non-grantor trusts that can be useful for income tax planning. So just a little bit of the pros of IDGTs or the non-grantor trust is they're irrevocable. I can't take the money out. The assets can drop to the beneficiary. It can accelerate. The beneficiary can have them early. I could just give them, or the trust could just empty it out to my son, depending on the rights they has, but I can't get it back. It can cause a tax drag, the IDGT, if I'm paying taxes on this thing, but I'm not necessarily, getting the money. It could cause a burden, though the IDGTs we have provide for reimbursement of taxes. So that's not necessarily a problem because we can draft around that. And the IRC, the tax code says that that's fine. So depending on, there's some audit valuation risk if you're using specialized assets or closely held stock. You also can't have powers that you're not supposed to have. You usually need a neutral trustee. So those are some things where there's some pro and some con. Again, like also with dynasty trusts, if really one's going all in on dynasty trusts, well, depending on the concerns that we have, we may need to locate that. And in many situations, we may need to locate the trust in a state like Nevada or Washington. And sometimes clients are just, this doesn't match what they're looking for. Some clients, they say, that's exactly what I'm looking for. That's matching me very well. So that's essentially the way that these work. Let's go on to our last slide here. I think this is our, one here just very briefly, as I'm very little short on time, is private family foundations. These can be also, this is probably the third biggest thing that we deal with. Private family foundations are family-controlled charities. Charities that are funded by a close group and are not funded by the public generally. These are generally designed so that I can make large charitable gifts. I can take the deduction now, but I only have to dole out 5% in my grant making to other charities per year. So 5% of the total. So if I want to, because I had a big capital gains recognition in this year, I say I need a big deduction, or maybe I want to commit to ongoing funding of a private school or something, but I want the deduction now. I can create the private family foundation, put the big contribution into the family foundation, get the charitable deduction right now, but I only have to dole out 5% per year. In addition to this, my family and I have a lot of control over the ongoing investment. How does the private family foundation invest the funds, and how it doles out those funds to the charities that it wishes to support. I, of course, absolutely cannot self-deal. I can't do active business with this, and I can't do risky investments with this. It's highly limited. But what is it for? It's really to centralize family philanthropy and gift giving, build long-term legacy, involve and educate family in charitable activities, fund sometimes special niche causes or charitable activities that are more personal to us rather than just giving to the Red Cross. And again, to maintain, if we're going to be doing a lot of charitable gifting, let's have something that perhaps my next generation can learn from and accumulate, and that we can have a lot of flexibility on this. Also, eventually my children or whomever can work for the family foundation, providing they are compensated for the reasonable market value of their services. They can't get a salary of $500,000 a year. They say, well, what did you do? I said, I don't know. I talked to the lawyer and told him to do what he's supposed to do. I talked to the accountant and told her she's supposed to do what she's supposed to do. And then I took a nap. Well, no, then you can't get $500,000. That's not worth $500,000. If you're active and said, oh, I'm doing charitable activities, I'm involved, I'm networking, I'm doing all these things, I'm driving around and I'm keeping track of my time, and I looked for comparable jobs of that time commitment and everything, and the salary pools around X amount, and I kept a good file on this and I can prove it, well, then maybe you're okay. So it's a great way to say, maybe instead of giving my child the $10 million, I'll give him $5 million in a job. How about that? You can do that with the private family foundation. Let's see our last slide here, the pros and cons. Pros, it's very flexible and you have control. You have deductibility for the contributions all in year one. It's a perpetual, stable vehicle for governance and value. The cons, as we mentioned with all these, the administrative burden of setting it up and administering it. Sometimes you have lower deduction limits for AGI versus public charities and donor advised funds. There also can be issues with closely held stock. Also, the 990 PFs are public. So what is in the charity, one can generally learn. Going through the 990 PFs is actually quite complicated, but it is technically public. So that is essentially private family foundations. Let's lead to our final slide, what's coming up next, and I can kind of have our lead out of what's going forward. So this is, hopefully this was helpful. I know we sort of sprayed a lot of information at everybody, and I am told that I speak very, very quickly, but we wanted to get a lot of content in, and so take a look at our contact information, and you can also re-watch this. This will be posted up on our YouTube channel. So if you say, Mike, that was just way too fast, that you blew through this in an hour, okay, no problem. Hop on our YouTube channel, watch it slower, re-watch it, get information from there that I hope is helpful, and then you can reconnect with us and see, did one of those or a combination of those seem like something that you say, you know what, that I need to know more about, and that I actually, now I want you to, I'm going to tell you my situation, I'm going to see if that fits, like, let's go to that stage. Perfect, we look forward to it. That's why we wanted to give information about these, so that you, as a legal consumer, as someone looking at these, you kind of say, okay, that one, that's kind of, capital gains tax, that's kind of the problem I'm having, let's explore that. Or asset protection, that's the problem that I'm having, let's explore that. Or high income issues like that are recurring, that's the problem I have, let's talk about like private family foundation. Or I'm charitably inclined and I'm giving a lot to charities, but I don't think I'm doing it in the right way. Let's talk about that. So I would love to talk to you. There's all of our contact information. Again, you can see us on YouTube again, and we look forward to seeing you again next month. And I think we may even have this month, do we have our Chinese seminar, or will that be next month?
No, actually, this month we won't have Chinese webinar, but next month we'll get
Perfect.
back to it.
Yes, so we will have a new seminar next month. And again, feel free to watch YouTube and see us again.
Sounds good. Okay, great. Thank you for joining us. We'll see you next time.
Great. Take care all. Bye-bye.
Take care.